The mistake people make is they assume that their CPA is doing everything possible to help them. And CPAs are really in a bad spot.
They're number people. That's their job, is to be in the lines and the numbers, right? So you kind of have to pry that open. So what'd you end up recommending for that dentist making $2 million?
Let me preface it like this. Anything in my ecosystem, anything that I talk about is going through extensive due diligence. So I'm about to beat up the dentist because they are notorious for joining these clubs that cost tens of thousands of dollars, if not more, where Ponzi schemes are promoted and they lose money.
Welcome back to another episode of Dental Marketing Go. I'm your host, Gary Bird. I'm the founder of SMC National, where we help offices just like yours level the playing field against the big DSOs out there. And you need more help than ever before to be able to compete in this market. And we help you grow your new patients so you can grow the way that you want. And today I have Brannon on, and he helps you fight a bigger guy than just the DSOs out there. He's helping you fight the IRS. No one likes giving extra money to the IRS, and he's going to give you a couple hacks. Most of these you probably never heard of before, and it's going to be really, really interesting, and you hopefully can save some money. At the end, he gives you something that's going to help you out. You're going to want to watch this one. Stay tuned. We are live, and I got Ross here, and I'm excited to have this conversation because it comes up all the time. I know people think about this because I think about it, and it's tax season, so I was just having a conversation with my CPA and just like, hey, what can I do not to pay so much taxes? What do you mean? Can I move this money over here? What if I did this? What if I relabeled this? And I know taxes a lot of times is semantics, and labeling things one way versus another can make a huge difference. So Ross, I'm excited for you to share with the audience because I know this is your wheelhouse. What are dentists doing right now to save money or take advantage of tax, different things going on with taxes? What would you tell our audience?
Well, let me kind of circle around a loop to get there. So I would argue that owning a small business or owning a business is the greatest way to create wealth. And owning a dental practice is a business that allows you to create wealth. However, if you give a large amount of your profit away to the IRS or your state, that negates that. So I would argue the highest rate of return you can get is illegally taking $1 back from the IRS or your state treasury.
Because that's straight profit, right? So every dollar that you get back from them is just profit, cream on top. Yes.
Right. So just like typically, the highest rate of return you're going to get is investing in your business. Well, just like taking $1 back from the IRS is a very high rate of return. Now, the mistake people make is they assume that their CPA is doing everything possible to help them. And CPAs are really in a bad spot. I would argue, I used to be really critical of them. I would argue it's not their fault. So think about this. Let's say your CPA has 1,000 clients and you're a high-performing dentist. You're probably in this top 5% of clients. And he's got all these deadlines all year long. He doesn't have time to go figure out how to help you save taxes. And if he did, he doesn't know how to make money doing it. He's like, I'm going to go spend all this time and effort, but how can I get paid for doing it? So the reality is it's not his fault or her fault, but that's the way the system is set up. And so we do a lot of work collaborating with CPAs. So there's all sorts of ways to reduce your income with tax strategies. But to lower your taxes, you have to fundamentally do something different with your money. Now, the lowest hanging fruit, the easiest thing you can do is a retirement plan. You may offer a retirement plan in your practice. You may not. If you don't, I would highly consider doing it because A, your employees will like it, and B, you could structure it to a profit sharing plan where you can, I don't remember the exact numbers, but mint $60,000 you can contribute. Well, you might say, well, that's not enough. I want more. If you have a good census, meaning the demographics of your employees, you could do a cash balance plan, which could honestly take you up to over $200,000 of contributions, which is a great idea. Obviously, there's some low-hanging fruit like paying for kids.
What's a cash balance plan? What is that?
It's called a defined benefit plan. So it layers on top of a 401k. Now, you have to do a census, meaning the demographics, the age and gender, and the salary of all your employees determines whether it works. So if you have a bunch of old employees, the census will not work in your favor. If you have a bunch of young employees, the census will work in your favor. These are things that everybody should consider. If you have kids, pay your kids. And then once you make so much income that those things don't move the needle, then you call a guy like me and say, hey, what can I do? I was on the phone. Today is a Monday when we're recording this. I was on the phone with an orthodontist in Sacramento, California on Friday. They make $2 million a year. They're like, my CPA is not helping me. What can I do? And we had this exact conversation. I said, well, there's lots of things you can do, but they're facts and circumstance dependent. So what's good for me isn't necessarily good for Gary and vice versa. But we'll have that conversation, loop the CPA in, make sure the CPA is on board. Sometimes, we want to just educate and train the CPA to do this, but sometimes the CPA is just too curmudgeon-y and not open-minded, and someone has to change CPAs.
There are a number of people. That's their job, is to be in the lines and the numbers, right? So you kind of have to pry that open. So what did you end up recommending for that dentist making $2 million?
Well, it was a conversation with the female, but she was married, her husband. I said, let's hop on a Zoom. Because it was a 15-minute conversation. Let's hop on a Zoom. Let's talk to both of you, because it's a dual person decision, and let me get some facts and circumstances on you. So I don't really know, they have 3 kids and they make $2 million a year. That's all I know. And so we'll kind of take a deep dive into what they have and what their situation is. And then based on that, we'll talk about some potential things. In my head, I have an idea of what might make sense, what might not. But just because I think it's a good idea doesn't mean they're going to like it. Like I met somebody last year.
Could we walk through some of those things? Like just what you think?
For example,
because I think that will serve our audience. Our audience is going to hear and listen to this. And
so here's a low hanging fruit. This is something I've personally invested in, and I receive income from that. So, and let me preface it like this. Anything in my ecosystem, anything that I talk about has gone through extensive due diligence. So I'm about to beat up the dentist, because they are notorious for joining these clubs that cost tens of thousands of dollars, if not more, where Ponzi schemes are promoted and they lose money. I know people who have lost $2 million in these masterminds or these clubs where we're going to source deals for you, and they don't even know how to spell due diligence. And so, we're in the most due diligence in ecosystem there is. The stuff you hear about doesn't happen in our world. So but this is a low hanging fruit thing called, it's IRC, Internal Revenue Code 263C, and it's working interest oil and gas. Oil and gas working interest. You are investing in the development of an oil and gas well. Now, you would not want to do this if you think oil and gas is bad and you are really, really pro-green. I'm not here to debate you on that. If that's your personal preference, that's fine. Oil and gas, probably not for you. But if that's not your perspective, then if you invest in an oil and gas well with a legitimate, fully due diligence sponsor on where the reserves are proven, this is not wildcatting, this is proven reserves. Basically, there is technology that tells you, hey, there's oil and gas down there. We know, it's just a matter of execution. When you invest in those, typically speaking, you invest $1, you get an 85-cent deduction. You invest $100,000, you get an $85,000 deduction. Now, we underwrite these to perform at a 1% per month income distribution. Do they outperform that? Many times they do, but I'm going to tell you 1% per month because I would rather underpromise and overdeliver.
So what does that mean? So what am I getting? So I put my 100,000 in. So what would I be getting out on a monthly?
But you would get $12,000 a year, $1,000 a month based on what I'm telling you. And it's a perpetual income stream. Now, the rates of the income distributions are not guaranteed. They're based on the commodity markets. So if oil's at $100 a barrel, you're going to get more income than if oil's at $50 a barrel. Right now, oil's around $85 a barrel as we record this. So you don't want $200 barrel oil because that creates people stop using oil or they try to stop using oil as much as possible. But you do this and you buy a perpetual income stream. Now, the oil and gas has a decline curve. So it'll start the first 2, 3, 4 years. It'll be pretty strong. It'll slowly decline over time. Sometimes these partnerships are structured where they sell the acreage and you get your money back plus interest and all that at the end of a certain period of time. Most times it's a perpetual income stream. So I've done this myself. I love it. Mine comes on the 25th of the month. It's my favorite day of the month. My checks are nice.
You end up getting back all your money that you invested.
Yeah. So you get all your money back, you get the deduction, and then you obviously get profit. Now the profit is determined by the oil and gas price. Now, when I tell you 1% a month, some people might say, well, that's not great. Well, I would tell you, if you got 12% a year in the stock market, you'd probably be pretty happy.
Yeah.
And this is net of anything. You get 12%.
But then you're getting the write-off too, though, because if I invest that $100,000 in the stock market and then I sell it, I'm actually paying taxes on the 12% rather than getting the deduction, right? Am I understanding that correctly?
Yeah. So I don't have a problem with the stock market. I'm just saying they're really apples and oranges. If I put $100,000 in the stock market, I'm not going to get a deduction unless I put in a qualified plan, like I was talking about earlier. But if we're not talking qualified plans, I put $100,000 in, I'm not getting a deduction. I put $100,000 in, I get 85%, $85,000 deduction. Then I get income that's coming out. Now, obviously, the income, the stock market portfolio is variable to go up and down, to go up and down. I can obviously do much higher than 12%. I can do much lower than 12%. And I'm being conservative in my 12%. I'm not going to tell you the percent that I'm getting on mine because I don't want to overpromise. But typically speaking, if oil's at $85 a barrel, you should do better than 1%. But I'm going to tell you 1% a month. But it all comes down to proven reserves, not wildcatting, fully due diligence, criminal, financial, experience background check with all the people involved. You know, making sure you've got, like, I've been on well sites, on well pads in Texas. I've had geological engineers sitting there with me. I've done that. That's what we do to help our clients out.
So is that would you say the main tool in your tool belt?
That is the low hanging fruit. So for example, if you're making, I'm going to generalize this. Don't hold me to this. If you're making $800,000 or less, that's what we're going to talk about first. You might love it. You might not love it. And we'll have a conversation about that. And, but there's other tools that are more complex and sophisticated that make sense for people who make higher incomes because of the complexity. Now, I'll tell you right now, I had a general dentist in Alabama make $3 million a year. And she said to me, I will basically do anything on this earth not to pay taxes. I showed her something and she says, I won't do that. Now, I felt like I was listening to Meatloaf sing, I would do anything for love, but I won't do that. And I'm like, that's fine. You can do that. And this year she might do that. We'll see. We'll have a conversation. It was kind of her. She didn't fully understand how the whole thing worked. It's a complex structure, but it makes a lot of sense. And I don't want to dive into the details on that strategy just because of the complexity of it. Yeah. But there's other, I mean, for example, it depends on what your spouse does. If they're a real estate, if they do a lot of real estate stuff, that opens the doors for some other tools that we have. But ultimately, you should do the qualified plans. You should consider a defined benefit plan. You should pay your kids. You should consider the Augusta rule, renting out your house to your business for 2 weeks. And then if that doesn't move the needle enough, then we can have a conversation. And you may already have somebody who does this type of stuff, but, you know, An oil and gas.
One thing about the Augusta plan, I've heard of that before, where you rent out your house for 2 weeks out of the year for like corporate planning, stuff like that. What's the difference between that and then just deducting a portion of your house every,
like a home office?
Yeah, like a home office. Like what's the
well,
difference?
You're charging a market rent. So you could figure out, okay, what's the market rent for my house? I'll charge a pro rata market rent for per day. I mean, some people don't want to do that. They don't want to have events at their house, and that's fine. But it's a way to get a few dollars of a deduction. Sometimes I find these lower level deductions aren't worth the time and effort. I would rather go buy $1, $2, $3, $4, $500,000 of oil and gas. I mean,
got it. Yeah.
I am very bullish on oil and gas, and quite frankly, I would argue that everything that you could see in the picture from Gary and I has some level of oil and gas in it. There is a 99% chance that something you're wearing has oil and gas in it, unless you are in all cotton, including your shoes. Your phone has oil and gas in it. But I'm not here to be a spokesperson for oil and gas. I just have seen the benefits of using it as a tool for tax reduction and wealth creation.
Awesome.
Now, but please hear me. Someone's going to hear say, oh, all he does is talk about oil and gas. That's all he does. No, I have so many other tools. I just don't want to explain them on a podcast, get misrepresented, and which we all know how that goes.
Yep. Well, this has been really, really good. Clearly, you have a lot of things. You've talked about a lot of things I haven't heard of before, and I know that it sounds like you're helping a lot of people. If someone wants to reach out and like say, hey, I want to give you my exact scenario, and I want you to give me the breakdown, what's the best way to get in contact with you?
Say, I answer any phone, any phone call that comes in, or most people like a text. So I'm going to give you my phone number. It's 850-566-7999. 850-566-7999. Call me, text me. I'll respond. I don't bite. I'm here to educate however I can help.
Well, that's awesome. Thank you so much for coming on, Ross. You did a great job, and I love the energy, and I love the different approaches. This is what is needed, because the one thing we can all agree on, don't give your money to the IRS.
Thanks so much, Gary.